And Lance Roberts of Street Talk Advisors joins us now to try to understand this a little bit. And Lance, let me start with this because Washington settled the debt deal. A lot of people, there's a lot of perception that they settled that, everything would be hunky-dory, and certainly not the case at all. Why?
Well, because first of all, the debt deal never mattered to the markets. If you look at interest rates, which are driven really 4 times larger than the actual stock market as the bond market, interest rates remained actually at low levels and actually went lower during the whole debt debate crisis. So when they were threatening default, interest rates were telling you there was no event of default on the horizon, and the markets didn't really care about that. What they cared about was a very poor package that was passed. And now the realization is that we have now only kicked the can down the road for a couple more years in terms of our debt problems, and we've done nothing to actually resolve the issues.
And there were humans and there were computers at work today.
Absolutely.
It was the work of the humans, though, that brought the computers in, right?
Well, we brought them in, and of course, you know, it's like Skynet.
Yeah.
It's just that now they've taken control. 80% of all the volume is handled by computers. So when markets start to decline, they break technical levels in the markets, and then that triggers the programs to start selling more, and it feeds upon itself. This is one of the real drawbacks over the last decade of automation in the markets that causes problems when markets go. It works great on the upside, really bad on the downside.
But there are humans that are not happy with what's going on with the economy. There is also the prospect of problems across the pond in Europe as well that is driving part of this. Spain and Italy really on the horizon now.
Well, again, you know, this whole debt deal took everybody's focus off Spain and Italy. They never went away. That's a huge crisis. But more importantly now, and something I've been talking about for about 6 months, is that the economy is really weak, and we are getting weaker every day. And if we don't have another round of stimulus, so barring another stimulus program by the Federal Reserve, we will be in a recession by the end of the year, and that's what the markets are picking up on today.
This is the double dip that we've heard discussed again and again and again.
Exactly.
Especially today.
Exactly.
So you're a proponent of QE3.
No, I'm not a proponent of it. I'm just saying if you don't want to be in a recession, that's about the only thing that'll keep us out of one.
So you may not be saying let's do it, but if you don't, if money is not injected in large volumes, basically a lot more money printed, because it's coming out of thin air essentially.
Exactly.
Then the recession is on us again.
Exactly, but it's not. But that's not the end of the world, and we have to go through this process to clean off the balance sheets. This is the problem. We're in a deleveraging balance sheet recession. We've got to go through that process. QE1, QE2, potentially QE3 is just delaying the inevitable, and everybody in Washington is afraid of a recession. But it's just part of the cleansing process we're going to have to eventually do either now or 2 years from now.
We have lots to talk about in the coming weeks, and we will do that.
Months. Yeah, absolutely.
Lance Roberts, thanks very much.
My pleasure.
Appreciate it.
Thank
Melinda.
you.